Alright, let's be real for a second. One day the US stock market is pumping. The next day it's dumping hard. Dow's up, Nasdaq's down, S&P 500 can't decide what it wants to do. So everyone's asking the same question. Why are US stocks so volatile right now? Is it inflation? Is it AI hype? Is it jobs data? Or is the trade war drama back again? Don't worry. In this video, I'm gonna break it all down in plain English. No Wall Street nonsense, no confusing jargon. Let's get into it. First up, inflation. Yeah, that word everyone's tired of hearing, but it still runs the market. Even though inflation has cooled down compared to last year, it's still sticky. And Wall Street hates uncertainty. Here's the deal. When inflation stays high, the Fed keeps interest rates higher. Higher rates, but borrowing gets expensive. Expensive borrowing, companies slow down. That's why every time CPI or inflation data drops, the market goes crazy. If inflation comes in lower than expected, boom, stocks rally. If inflation comes in hotter, markets freak out and sell off. So yeah, inflation is like that one guy who walks into the room and kills the vibe. Now let's talk about the hottest thing on Wall Street right now. AI stocks. Companies like Nvidia, Microsoft, Google, they've been on an absolute tear. AI is changing everything. Software, healthcare, finance, even regular office jobs. Investors see massive future profits, so money keeps flowing into AI. But here's the catch. Some people think AI stocks are getting overhyped. Valuations are stretched. Expectations are sky high. So what happens? One good earnings report, stocks moon. One bad headline, stocks crash. That's why tech-heavy indexes like the Nasdaq are super volatile right now. AI is exciting, but it's also making the market way more emotional. Now here's where things get weird. Normally, strong jobs data is a good thing, right? Not always. If jobs numbers come in too strong, the market thinks, uh-oh. The Fed might keep rates higher for longer. More jobs, more spending, more inflation pressure. So sometimes, good jobs data, stocks fall. Weak jobs data, stocks rally. Yeah, sounds backwards, but that's the market for you. Investors are trying to guess what the Fed will do next, and jobs data is a huge clue. That uncertainty keeps stocks swinging up and down. Now let's zoom out for a second. It's not just the US, it's global. Trade tensions are back on the table. Tariffs. Supply chain risks, political drama. Whenever the US starts talking tougher trade policies, markets get nervous. Why? Because trade wars increase costs for companies, hurt profits, slow down global growth. Big investors hate surprises, and trade issues bring a lot of them. That's another reason volatility keeps spiking. Let's be honest, the market right now is emotion-driven. One day it's, rate cuts are coming, buy everything. Next day, recession is coming, sell everything. Social media, headlines, breaking news. Everything moves faster now. Retail investors, hedge funds, algos, everyone's reacting in real time. That's why we're seeing sharp rallies, sudden pullbacks, big daily swings. The market isn't broken, it's just confused. So what's the takeaway? US stocks are volatile because inflation isn't fully under control. AI stocks are hyped but risky. Jobs data keeps confusing the Fed outlook. Trade war fears are creeping back. And investor emotions are running hot. If you're a long-term investor, don't panic. They stick to solid companies. Think long game, not daily noise. Volatility creates fear, but it also creates opportunity. If you want more real talk about the US stock market, no fluff, no hype, hit that subscribe button. And I'll keep you updated on what's actually moving the market. See you in the next one.